Abdullah, do you want to kick this off?
Yeah, like Jamie said, thanks for waiting. Um, and the purpose of this webinar today is to keep it knowledge-based and informational. And while we were preparing this, we continuously kept asking ourselves, what is the few things that you can take away into your day-to-day? So we'll be pretty focused on what you need to know related to these laws and try to cover all the basics. We won't go into too much detail, but if you have any specific questions, please feel free to participate in the chat and somebody will answer it for you. Or if it is being recognized by more people as a similar pain point, me and Jamie can also take turns answering it.
Thank
So,
you.
yeah, moving on, Jamie, do you want to kick it off with a quick introduction about yourself?
Sure. And we got into this a little bit before, but for those of you who just joined us, I'm the Director of Sustainability for Clearyst. I've been working in pure play sustainability programming for the last 15 years, maybe more. I started my career working for Red Bull North America energy drink. I was in marketing and sports marketing, and after 7 years, switched in and became their first ever Director of Sustainability. Um, got my master's in sustainability, and ever since then have been serving clients large and small. I took a break from sustainability and worked in educational governance programming for a few years, and then came back and 3 years ago joined Clearyst, where I lead our advisory arm and I take a consultative sales approach where I really try to guide clients through where they need to be in their own journey. And then I'll pass it back to you.
Thanks, Jamie. And yeah, like I probably covered a bit of about Arbor story and how it got started, but my role at Arbor is I'm the Chief Impact Officer and co-founder. I have spent years in research and supply chain and heat transfer, and we really wanted to build something that would tackle the biggest challenges related to carbon management, specifically data collections, filling out hard to find data, and not only get audit ready calculations, but support companies through audits and assurances so human capital can be better spent elsewhere. And moving on, for the agenda today, we have three main line items. So obviously, SB 253, most of you may already be familiar with that, but we will go into each one of the regulations, SB 253 and 261. And then at the end, we will try to answer as many questions as we can. But if we can't get to all of your questions, we will reach out after the webinar to answer anything specific to your situation. And before we begin, we wanted to put a quick survey out there just so you can kind of get your own specific context in, as well as ask any outstanding questions that you have. Our team will review the survey responses and then them in the chat if it is something that we can answer and we have enough time for. But if we can't, we will reach out with a personalized, customized answer to the most urgent questions that you may have. And yeah, so kicking off with the first item on the agenda is the SB 253. I'll provide an overview of all the things that you should know today. And obviously, with most regulations, there are moving pieces that are in the works, and there may be updates in the future. So, as a legal disclaimer, this is not legal advice. We are hoping to bridge any knowledge gaps that may exist within your businesses or within your role as as it pertains to these upcoming California laws. Now, going into California SB 253, this specific part of the regulation talks about the annual disclosure requirements of companies around scope 1, 2, and 3 emissions. I'll go a little bit more in details on what they are. But the timeline so far is that you only need to worry about scope 1 and 2 emissions for next year's submission, and then scope 3 emissions would be in 2027. Now, that being said, it is something that I want everyone to understand that they should probably go together in a combined strategy. There is a lot of know-hows, do's and don'ts within these uh, scope 1, 2, and 3 categories specific to different industry. So we will be following up with some resources on how you can familiarize yourself and get a good understanding of what these frameworks mean and how they can be used within your current roles. So, moving on to some of the common pitfalls, I would call them. They're not really challenges, I would say. This is something that I've seen a lot of companies go through. Most sustainability companies that haven't been asked for compliance measures don't really have a robust climate management program. This could mean that they don't have a sustainability department, or there are some business gaps that exist between who takes the ownership of it. So, as part of this, I would advise you to start thinking about what those things are and how you can bring them as part of your organizational structure. So there is direct people that you can be decision makers to, be guiding the strategy, and as well as implementing the governance part. The other part is that there are significant sustainability knowledge gaps in the industry, right? Like nobody went to school for this stuff, nobody covered it as part of their business school or engineering school or law school, but that does not mean that these things are complex or hard. I'm akin to saying that if you understand middle school math, like it should all start make sense to you once you familiarize yourself with all these concepts. The part that it gets interesting around is the compliance anxiety. It is something that brings a business to be aware that they have to report and disclose, and these gaps amplify those anxieties. So if you have a good understanding on your business gaps and your knowledge gaps, and you can have a plan in place to fill them out, the clock kind of takes care of itself. Now, moving on, the purpose of SB 253, like other climate-related regulations, is around the intent of the regulations. The requirements, the timelines will get refined over time, but essentially the main purpose is to bring radical transparency in the industry and create a leveling field instead of voluntary disclosures and the unstandardized nature of them to and then the second point is to figure out what those climate risks are to businesses and people within communities and try to put a price on that systematic risk and not just disclose for the purpose of disclosing. And this is very important because whatever you do today, it will impact your business in the next 2 to 3 years, but it could have a drastic long-term impact as well on your bottom line. So, how to be communicating the actions as part of your disclosures is going to be a key purpose of these regulations. And then moving on, their timeline, I kind of covered it a little bit earlier, but right now the proposed timelines for your scope 1 and 2 calculations and disclosures is June 30th in 2026. For a lot of companies, they may have already started with a few initiatives internally or through expert help, but the timelines are going to be confirmed later this year. Currently, right now, there are a few open items from CARB, the regulatory body behind these regulations, around the scope 1 and 2 template on disclosure. There's an open comment feedback session that finishes on October 27th. So if you haven't checked it out yet, I would recommend to go on CARB's website and see the template. And if you have any questions, we're happy to answer them. But if you want to go on record and provide a public comment on the timelines, you can also get your word in while there's still timelines. Now, the GAG protocol. This is something that is particularly referenced in SB 253 regulations, and it is the world's most foremost standard around how companies account for carbon emission at an organizational level. Now, there are a couple things that may seem confusing to people. I have answered a lot of questions like, where does my Uber receipts go? Like, if I take an Uber for my business, does that belong in scope 2? Does that belong in scope 3? And these are the kind of questions that I do understand come up quite frequently as you're looking at your business activities. But having a good understanding on what scope 1, 2, and 3 are isn't that complex. So I'll kind of give you a quick breakdown of how I interpret these definitions. And I think it is true in almost all cases. So scope 1 emissions are emissions you can see from your eyes. So like, an exhaust pumping out emissions is the easiest way to visualize it. Tailpipe emissions is another source. Scope 2 is indirect emissions. So if it's purchased electricity, if it's related to energy use that you are not currently having it on your site, but you're using another source for, that's scope 2 emissions. And everything else is scope 3. So scope 3 has a very basic definition, but for different industries, it could be so complex at times. So, for financed emissions, for example, a bank who has to report scope 1, 2, and 3, this will include all of your portfolio, all of your lending portfolios, all of your investments, and collecting data for this can be a challenge. But for most companies, generally, that are involved in physical goods, scope 3 purchase goods and services makes up for 90% or more of your emissions. So everything that you purchase, everything that you're getting from a supplier, it all gets accounted in scope 3. Now, moving on, these steps are really common, right? So I don't want to necessarily say you have to make sure that you're doing this. I'm assuming everyone who understands data, have done any sort of measurements or disclosure work, understands these processes. So, what I think you should take away from these steps is the context of your business. So understand the type of business and the type of industry you are. That will help you create the inventory scope and boundaries. Understand where your biggest spend is or your biggest revenue is coming from. Those essentially multiply into the larger portions of your emission sources without having to do the calculation itself. And the purpose of that is to drive where your human capital should be going towards, where you should be focused on collecting high quality data that can end up solving the intent behind these regulations and come up with a more stronger posture for your company when these results are made public. Now, moving on, obviously, calculating emissions. This one is sometimes made out to be rocket science, but it's not. There is significant alignment within GHG protocol. There's a lot of examples. And a couple things to keep in mind when you're calculating emissions is to understand different use cases on emissions that you have in mind. So, a few that are very relevant to this year. One is the ISO collaboration with GHG protocol. See if there are anything that you can do to start organizing how to use ISO frameworks as part of your emission calculating strategy. There are things like document trails that if you start working on when you're creating these emissions calculations will help you not only pass the assurance that's needed next year, but be able to trail back and make edits and improvements 2 years from now, 5 years from now, or even 10 years from now. And then aggregating and reporting is something that a lot of compliance teams already have familiarity with, but having some sort of internal processes around how you document what you aggregated, what the assumptions were, is very critical, especially if your company has ambitions to not just comply, but to be in a competition amongst your peers, be part of SBTI, use the data for CDP. I'm sorry, I'm throwing a lot of acronyms out there and I'm assuming people understand what they are, but these are the type of business use cases that you can still reuse the data for if aggregated properly. Now, moving on, there is a lot of common questions that we have found a very common theme amongst, right? So one of the things that I wanted to spend a bit time today was what does good faith effort mean for compliance? This is something that CARB has specifically said that scope 3, which is quite a challenge for some businesses, has certain uncertainty in numbers. And the good faith effort essentially means that it is a provision to protect creativity, innovation, and how you're capturing and calculating this data. And this is why the documentation part becomes more and more important. Secondly, if most of a company's business is outside California, and it exceeds the revenue threshold. Should I still comply? This is very interesting because if you don't know this already, there is a publicly available list by CARB on US domicile companies that may be impacted by these regulations, but international companies have no certainty from CARB via a list, but there is a survey available on CARB that allows you to ask them if you do comply, if you must comply or not. So I would suggest going through that route. But the rule of the thumb is that if you're making more than $1 billion globally and you have more than $750,000 coming from revenue coming from California, then it would also apply to you. So that kind of answers my last question too, but there is an unlimited list of these questions, and we will be offering a FAQ list as part of the resources for all the attendees today. Now, moving on, I think sorry, if you could go back to the last slide. Yeah, so like I mentioned, there are a few resources that we've prepped. Like I said, we don't mean to show you the tools that Arbor has or the services that Clearyst could provide, but our ambition is to provide knowledge that can fill in the gaps amongst either your business or your current sustainability knowledge. So what we have is a guide that kind of breaks down the most important things to know and the do's and don'ts for SB 253 and 261. We have a SB 253 checklist, which is great for program managers, project managers, anybody involved in managing the progress on SB 253, as well as some links and resources that are directly by CARB, so you can follow the letter of the law from the source itself. Now, moving on, just so everyone's a little bit familiar with high-level comparison between these two regulations. One obviously is who does it apply to? So SB 253 is only for companies and organizations that have $1 billion or more in revenue that also are operating in California. Like I mentioned, that means the $750,000 limit that exists. Now, how CARB has come up with a list of company is a very lengthy discussion. So if you think you're on the list and you don't belong on the list, I still recommend using the same survey link to contact CARB and confirm whether or not the SB 253 regulations also apply to you. SB 261 regulations, however, are addressed to a larger group in the market, which includes organizations more than $500 million in revenue that are also operating in California. The main difference between them is the reporting frequency. SB 253 is annually required, moving on from 2026, and SB 261 is the report which Jamie will go a little bit more in detail into, but is following the reporting frameworks of TCFD or IFRS S2 that needs to be published every 2 years. And penalties are just a way to get more companies to take this more seriously, but there are significant penalties involved for companies that do not comply. So I definitely recommend making sure that if you are not sure that whether or not these regulations apply to you, I would try to get ahead and get the answer as soon as possible. Now, before I pass it on to Jamie, I think there is one last thing I want to just add to the point is there are quite a few things that you can do with the data. And data itself can be used for many things in the business, but the data without narrative, without governance structure, without understanding what it could mean to the business is just data. So how you use this within a company is a challenge that you need to address first. And the data is a supporting source that will allow you to empower any strategy, mitigate any risks, create good comparability, and essentially create a case for ROI on why a company should do this other than the compliance risk, because there are market risks involved in this as well. So what your customers and what your investors also want to see can also be something that you can do within these frameworks. And yeah, passing on to Jamie for the SB 261.
Okay, yeah, thank you. That was a great explanation of 253. Just a real quick summary of the differences between 253 and 261. 253 focuses specifically on greenhouse gas emission disclosures, scopes 1, 2, and 3, whereas 261 focuses on more climate-related financial risk disclosures, the strategy, the governance, and the financial planning. I like to look at this as first you measure and then you manage, like age-old saying in sustainability. So it's a natural progression, the way these two Senate bills are written. Next slide. So we're just going to get into 261 here and how best you can prepare for for compliance here. So this is all about climate-related financial risk. It applies to companies with over $500 million in revenue doing business in California. Many multinationals are in scope. The difference between 253 and 261 is you do not have to, 261 does not require you to report on your emissions. However, you generally need that information to do the 261 report. Now, for the first year, if you haven't done your emissions for last year, you could do your 261 report based on how you're going to set up your governance and your strategy and how you're going to look at things. But in general, these two laws go hand in hand. Next slide. So this is pretty clear. The penalty for noncompliance is up to $50,000 in a reporting year. I'd like to take this slide to note there's proposed exemptions are nonprofits, companies whose only business in California are teleworking companies, government entities, and California independent system operators, and for SB 261 insurance companies because they have their own regulatory body. Next slide. Okay, so here are some of the common challenges with the reporting. And the first one for companies is often just understanding the requirements. So SB 261 is based on the TCFD framework, but California also adds in state-specific nuances. And so many companies are trying to figure out what does sufficient disclosure look like. And luckily, this is a progressive reporting period where there's limited assurance and not working towards a more full-bodied assurance to 2030. So you're going to start to hear terms like what is material risk and climate-related financial risk, or what is your governance structure. But translating that into what does it look like for your company is oftentimes where organizations get stuck. This is not just a checklist that you can go and check off. This is really where your climate strategy becomes alive in your company. So there becomes some ambiguity around what qualifies as a voluntary report and one that meets expectations. So there's really needs to be a collaboration between your legal team, your compliance, your sustainability team, and they often need to align. So this becomes a very cross-functional report. Data and resource constraints are also problematic when you're first getting started with this. You want to comply, but sometimes you struggle with the internal capacity because sometimes this conversation is just not happening. So the conversation needs to get started, and it needs to be looked at across the entire value chain. So collecting credible data on your operations, your supply chain, your emissions, and even these transitional risks, which we'll get into a little bit later, can be resource intensive. And then on a smaller company, smaller companies don't necessarily have an ESG team, making it feel really heavy on one person. And I've kind of gotten away from saying we need a team to do this. I'd like to think of there's a point person and there's stakeholders. And that way you're invited to be a part of the process to give input. The final area where there's a challenge is often just access to the quality and accessibility of the data, because the data is not organized yet for this purpose. And so oftentimes you go through this once and you figure out how you're going to redesign your systems to then report and potentially adopt a new software system or a new tool to help you do it. Right now, 261 does not mandate assurance. It will come later. And so there's time to get this organized. But regulators and investors and customers are watching how this is coming about. And so the trick is, how do you report in a way that's timely without overreaching or trying to promise too much from the beginning? And that's where this greenwashing term comes into play. But this is where you start to look at what tools become available to you and how to streamline this information. So now that we have these challenges, let's look at what how to focus on building out your strategy. Do we have a survey we want to do, or are we still going to? No. Okay. So just a quick high-level note, this is not just a compliance checkbox. This is a real market shift in how companies are expected to measure, manage, and report on climate impact. these Senate bills are really put into place to raise the bar and putting climate reporting on par with financial reporting in terms of details and accountability and organization. It means really getting comfortable with complex Scope 3 data, moving from Scope 1 and 2 all the way into Scope 3, and getting understanding these different frameworks that we'll get into a little bit later, like TCFD, and preparing for disclosures that will ultimately be publicly audited, just like financial reporting. I also want to note that I think right now 4,100 companies are required to report under SB 261. And as I mentioned, this is a progressive strategy that assurance will tighten in 2030. Next slide. So here's just a timeline. January 1st, 2026, the first climate risk report is due for 261, which means it probably needs to get started right now because nobody wants to be doing this on Christmas or New Year's Day. In June 30th, 2026, for 253, Scope 1 and 2 emissions and an audit are for 253. 2027, again, 253. And then back to 2030 is when the Scope 3 audit will happen for 2030. Every 2 years after January 1st, so January 1st, 2028 will be your next 261 report. Next slide. So you've heard about all these frameworks, and this is what kind of provides the roadmap and the roadmap for building out this report. So TCFD is the main reporting framework that is needed for 261, which it's a little confusing. The IFRS adopted TCFD and built upon it, which made it mandated. The components of TCFD are governance, which is essentially your board and your management oversight, and where the roles are described and how this is conducted. The next is your strategy, which identifies the risks and opportunities that hit the bottom line. It starts to bring in different climate scenario analysis where qualitative data can be used alongside quantitative data. You move that into your risk management, where you identify and assess and mitigate climate risks as it relates to what's material for your company. And then you start to set your metrics and targets, which is your quantitative emissions are optional in the first cycle in case you haven't done your first greenhouse gas emissions. So let's get into a little bit of this process. So the first step is naturally the first step of the TCFD process. And this is really the heart and soul of this conversation and what's required for 261. So setting up your governance team, committee structure, this is where it becomes alive in your organization. It's about the leadership accountability, who from the board, who from the executive team are actively engaged in overseeing climate-related risks and opportunities. This is where you can show your investors and regulators clear lines of responsibility, who owns this strategy and how often is it reviewed. This pillar is the foundation. Without governance, it's kind of like a foundation built on a crack. There's no credibility behind the disclosures. And then once you have your governance in place, you start to work on your strategy, which is the second pillar of the TCFD framework. How does climate change affect your business model and your plans? So this pillar connects your climate impacts directly to your business strategy. You're looking at transitional risks like regulations and market risks, not just the environment, but revenue and operations, supply chain, and long-term growth. And then it's also about resilience, which is more of the physical risks like weather. How can your business model withstand different climate scenarios, and how that's going to affect things like carbon pricing or extreme weather or flooding or consumer shifts related to any of that. And both of these transitional risks and physical risks need to be looked at throughout your entire supply chain, in your whole operations. And the strongest disclosures show how climate factors are embedded into overall strategic planning and how your capital is allocated. Next slide. So then we begin to look at the third and fourth steps of the TCFD, and this is aligned with your process. And the third one is the risk management, and it's how well are you identifying and assessing and managing those risks. And this is really all about the process, how you monitor and address climate-related risks alongside the traditional business risks. So you hear the term scenario planning, and this is what comes into play, like what ifs, the what ifs. Are climate risks part of your enterprise risk management system? And you demonstrate how you would solve for the climate risks and how that influences decision making in procurement, investment, and insurance coverage. One thing we do at Clearyst is we understand the importance of scenario planning. And I just posted about this yesterday on my LinkedIn page. This is really important work, but it's also important to know what is the very next best step. The next right move is what really will count. So while you want to do the scenario planning, you really want to focus on what's the next best move. And so that's where you really get into your metrics and targets. And this pillar is really where it becomes measurable. It's linking your goals, like what do we aim to do, to your accountability. And that's where you can measure. We aim to do this, this is where we got. It's setting metrics like our greenhouse gas emissions around scope 1, 2, and 3, how much energy we're using, and how that's impacting our climate related financial reports. These targets will demonstrate your intent to progress, and you can set science-based targets, and you can put reductions in place for net zero goals, and you can align them with frameworks. This just puts you on a roadmap and sets goals and targets. And this transparency helps stakeholders track your performance over time and evaluate whether your strategy is working. Next. So this is where you start to wrap up, all the quantitative data, and you start to gather the data and you build the backbone of your report. And it starts with that credible data around your emissions, your energy, your waste, your water, and all your climate risk indicators across the value chain. Remember that source of truth, that data is coming from many places, from finance, operations, facilities, suppliers. So it's important that governance is in place where you're getting the data from the right places. And then you want to engage with those data owners and those stakeholders early on, not to catch them off guard, because this is an extra thing they probably haven't had to do in the past. And a lot of people do find that if they leverage and integrate with a software system like an Arbor or another that will help them not reinvent the wheel. There's systems out there that will help you do this more efficiently. And then you're set up to do continuous improvement. This first data collection will help drive those systems and decisions in the future. And then you craft into a narrative, turning the data into insight. The numbers don't tell the story alone. The narrative explains why it matters and how it connects to your specific business strategy. You focus on what's material to your company and where climate and sustainability most impact your customers, your stakeholders, your business, and your value creation. You tie it back to the story of your own purpose and your own resilience and how sustainability now is driving innovation throughout your company and hopefully building your brand. So remember, this is a journey. We're looking on promoting transparency. No one's expecting everyone to have it done at first. That's why there's a timeline to this. And if you do follow the alignment with this TCFD strategy and pillar and framework, it does speak a similar language to the other reports that are out there. So there will be sort of an apples to apples comparison. And then finally, last slide, that this is not just a compliance report, but it's also a communication tool that meets regulatory requirements, but it also inspires your stakeholders externally. And then you have something to build upon year after year. Next slide. So just a little plug about us. We help guide clients through this. We provide end-to-end support in terms of simplifying the frameworks and digesting that and helping apply it to your business. We help guide companies through this cross-functional collaboration, bringing finance, operations, sustainability teams together to help you gain ownership and redefine these processes so that you can figure out what tools you need and how you're going to ultimately pull this report together. Next slide. And these are just a few of our capabilities outside of compliance reporting around, full-scale sustainability, pure play programming, sourcing, procurement. and communications. And I think that's it for my slides if we want to go to Q&A.
Thanks, Jamie. That was super informative. Yeah, while we wait for the questions to trickle in, I thought I'll come in and ask you a question. Have you seen any good examples on TCFD reporting, or now, like you said, IFRS has ingested what those recommendations were that you could recommend as reading materials or as a good example for companies?
Well, I think it depends on like which industry you're going after. There's thousands and thousands of good reports out there. What I like the most is some of the simpler ones. I think some people get involved in these 50, 60, 70 page reports. And what I really like to see is when companies actually simplify it and take the time to make it simple and focus on what is that key next step. It isn't about these big lofty goals and these what ifs. I mean, that's the balance that I think between the scenario planning and the actual practicality of what's real for our business and what is that next best step. So I think it's tough to say what I think is a good example of a report because it's so agnostic to every industry. But with that in mind, I'll pull up a few and maybe share later. We did get a question from Luke Daly. Yes, we can send the slides out. Absolutely. I do want to comment. We have a lot of information on these slides, and we did that specifically so that we could share this information. Normally, we would have more beautifully laid out slides, but there's a lot of information to share here.
Yes, no, and I think that's where the resources and guides also help clarify or provide additional reading material for people who are interested in diving deep, because as we both know, you could dive really deep on the data side or the strategy and governance side. And yeah, that's a lot for one person to take in 1 hour.
Yeah, there's a question here, and I don't know, Abdul, if you want to take it. What are the biggest misconceptions companies have about SB 253 and 261 compliance? Do these regulations align with existing frameworks like the SEC's climate disclosure rules or the EU's CSRD? Or will companies need separate processes? And what's one action companies can take today to ensure they're not left behind as these laws take effect?
Yeah, I think I can take a first crack, and maybe we take one question at a time because those are
Yeah.
three different questions. So
Yeah.
yeah,
Okay.
so I'll speak on the biggest misconceptions around SB 253. I think one of the biggest ones is, oh no, there's another red tape for me to take part in. So I've seen a lot of that as like an initial reaction where companies perhaps don't have sustainability reports or data measurement capabilities existing, but I can promise you that if you do the SB 253 right, as I'm sure you might allude towards SB 261 as well, it can be reused and repurposed for many things, not just for compliance. And that's where we were talking about like what that strategy is for that business as well. So I would say the biggest misconception is that it is not just another red tape. It's the start of something a lot bigger that will create pressures in the market and could create risks for certain companies and opportunities for others.
Mhm.
Do you want to speak on the SB 261 misconceptions?
Um, no, well, I was thinking I could move on to the next one.
Yeah, let's do that.
Sure. So there's from what my understanding is, and there's been a lot of changes with the SEC climate disclosure rules, that the cornerstone of SEC reporting will be on TCFD. So no, there will not need to be a separate disclosure process. Um, the the CSRD and TCFD do have some differences. It's CSRD is on a wider range of ESG issues, not just climate specific issues. There'll be a greater transparency around in the EU, and also they're looking at all of the social practices. They are looking at governance and they are looking at environmental, but it's not just specific to climate. So it's a bit of a broader look at the CSRD. And the audit requirements are also different. So I would say if you're complying with CSRD, it's going to be easy for you to comply with TCFD. If you're only doing TCFD, you're going to need to do more for CSRD.
Great answer, Jamie. And just to kind of add a couple of my thoughts to that question as well. Um, CARB specifically says they're trying to make sure that there is less repetition of work, so there's less of a uplift from companies and less repetition as well. So there is that option to comment back to CARB if you feel like that they're not staying true to their word, but I feel like yes, they are. Anything that you do for even scope one, two, and three, the standards, the methodology, the results itself can be repurposed for EU CSRD for the emissions work, as well as any other client or compliance requests that you may have. And
Hmm.
then moving on to the last question, what's one action companies can take today to ensure they're not left behind as these laws take effect? For me, this is a little bit personal question I've been very passionate about. Companies do many things, but there is a few things that they have a lot to do in, and these are usually your biggest revenue generators, your biggest spend items. So my ask for companies so that they're not left behind would be to focus on collecting more activity-based data for things that make up bigger portions of your business, because you having more confidence and trust in that data that you've collected will translate at the procurement level, at the CFO level, and at the board level when you present strategies and you present scenarios on how you want to mitigate risks or leverage opportunities. And the quality of the data is going to be at question in each one of those levels. So if you can, please focus on collecting high quality data for areas that are very critical to your business.
For those people who aren't familiar with the difference between financial-based data and account activity-based data, do you want to explain the difference so that?
Oh yeah, sorry. That's a good. Thanks, Jamie, for that. I'm a pretty nerdy about these things, so I can go pretty fast. So, um, in terms of GHG protocol, the main framework that is being referenced in these regulations, the lowest quality of data that you can use to measure is called spend-based data. So if you only say, I spend this much on this category, what companies use are spend-based emission factors to create carbon emissions results. And that data is very high risk because if down the road your supplier provides your data or you're able to collect better data, I've seen that number of that emission factor go anywhere between 50 to 200% of a change from the previous number. And that essentially means that there is a lot of uncertainty whether or not that is your company's footprint. So, an easy way to visualize the difference between spend-based and activity-based data is the difference between a general emission factor that may not represent your own supply chain and different businesses involved in your value chain versus an activity-based data would be very specific to people you're doing business with. And it will essentially inform how you manage those relationships in the short term as well as in the long term.
That's great. That's great. I also wanted to ask you on this, back to the first one on the misconceptions. One of the things I've heard from some clients of ours is they're reluctant to report because they're afraid they're going to get an invoice for the amount of emissions. Um, what what have you heard about the fees that might be associated with this reporting?
Yeah, so you're talking about the fees to submit these results, right? Like the
Yeah,
disclosures.
or even like, is there some sort of like, our some of our clients are afraid that they're going to be penalized for the size of their carbon footprint, you know?
Yeah, no, I think those are like I would say more anxieties than risks currently. So yes, maybe 10 years from now, there's a regulation that says if you create more emissions than your peer average, there could be something. But currently, those risks are not mandated, they're not spoken about, and it's something that I would say is a little bit scary to think about, but it is not something that will be used against them today. So, and in terms of the fees associated, so even if you have the biggest carbon footprint in the world for your company in your category, the fees to submit these results will not change. It's pretty flat. And if I'm correct, for SB 261, it's approximately $1,400 to submit these results. Um, and for 253, it's around about that as well. So
Mhm.
it's just a fees to submit. There is a lot of monetary impact on the board itself running this program, but that is not being passed down to the companies.
Thank you. I do think there's a lot of misconception around that hesitancy. Any other questions? If not, we did want to mention that at the end of this, we'll be sending out the recording, the slides, and some additional resources, including a checklist. Our QR codes are out there if anybody would like more information or specific questions that relates to their company or this process around 253 or 261. There's a survey, there's a QR code. Lots of ways to get in touch with us if you want to learn more.
Yeah, exactly. And if there's any specific questions that you come up with after that we didn't cover at this point, please feel free to also reach out personally to me or Jamie, and we're happy to provide some expert guidance on how to think about the question or answer it directly if it's simple enough.
Okay, well, if there's no more questions, we could give everybody 5 minutes back. Abdullah, thank you for co-presenting.
Likewise, Jamie, I found your presentation to be really thoughtful and engaging, and yeah, everything you said, completely stand behind it. And I'm hoping that strategy and governance, especially related to climate, become strong pillars in businesses, and this is just an excuse to start doing it.
Yeah, thank you. And thanks to Chip, Michael, and Omar in the background, helping with our audience and our technical and our slides. And with that, I think we'll sign off. Thanks to the
Perfect.
team at
Thank you,
Arbor.
everyone.
Thank you.